here's our box of revenue, green for money. Out of that, we take what it costs us to deliver that which was paid for by the customer to generate the revenue. We call those direct costs, or costs of goods sold. So in revenue, less cost of goods sold, or also known as direct costs, or the money that we spent in order to deliver the service or good, that's called gross profit. It's also sometimes called contribution to profit, or direct contribution to profit, or other names. But the important thing is the concept. Direct costs are important to keep track of, so that you know, if you don't make money delivering something to somebody, then you can't make it up in volume, they say. For example, if you lose money in every deal, no matter how many deals you do, you're going to be losing money. So the idea is make money on deals and then do more of it, and then make more money by delivering the good or service for ever less cost. So, and then gross profit divided by revenue. So you take this big green box here, but over this bigger green box, which you initially started with, and divide gross profit into revenue, and you get gross profit margin, or contribution margin. So the margin implies the ratio. Some people get lazy and they just call gross profit margin or gross margin. So you have to watch it when you're talking to people, but now that you know how the algebra works, you can ask a question to be sure well, you're understanding what someone is saying. Go down one more level, and we're going to take out indirect costs. Indirect costs are the costs of supporting the business, or sometimes called overhead. So general management, having someone in charge and making sure everything's going right. The cost of selling, the cost of the building you're in, the cost of managing the people, hiring the people, taking care of the people, the cost of finance and accounting, and all the other support functions of a business. Remember, we said we want to have only as much of these support functions as we need to do the doing, selling, and growing that our organization is starving for, and a little bit to allow for growth and improvement in those systems. And everything else we do, we should do as little as possible just to get what we are doing covered. In other words, we're not, if we're in the business of building houses, we're not in the business of accounting. So we want our accounting business to be as small as possible, but we want it to be big enough to do the job that we needed to do to support the building houses, and no more. I say that because in some cases, people get confused, and all of a sudden, they think we ought to have as big accounting department as we can possibly have. If you're in accounting, that might make sense. It doesn't make sense for anybody else. Gross profit then is the operating profit after the indirect costs. So we get operating profit here. Earnings, it's often referred to as earnings before interest, taxes, depreciation, and amortization. And if you were to break it here, earnings before interest and taxes, it would be called EBIT instead of EBITDA. And if you break it at the end, very end, it's just earnings after everything. So operating profit divided by revenue is the operating profit margin, or the gross operating margin. And then what we do is we have what's called non-operating costs, or the costs outside of the business, which would include things like interest, taxes, amortization, depreciation, things that don't affect the way the company operates or the organization operates, but that are real costs, but they're outside of the operating business. And that gives us net income, or what some people call profit, or just plain earnings. And then that number divided by revenue gives us net income profit margin, or profit margin.